Hey guys, I think it's about time to do a StoneCo video. I have been buying StoneCo over the last 3 weeks or so, and I've accumulated a position of about 12% of my portfolio at an average price of 804. And I've been researching this on and off for about 6 weeks now. And the more I read about it, the more I learn about it, the more I like it. Now I have a piece of paper that I stick on the wall next to the door of my office, and it says that I need to find two good ideas per year, and one of those I need to find one great business per year. Sort of along the lines of Buffett, where he wants a durable competitive advantage, the ability to raise prices, and amongst other things, high return on capital, and a whole bunch of other stuff. And so last year, my great business was Alibaba, and I accumulated that. So I've been accumulating that between July last year and I think March this year. And this year, I believe that Stone might be the great business for the year. Now, first of all, I just want to say thanks to the hardest working lazy guy I know in investing. I got put onto this by the lazy investor, so thanks again for that. Really a great find. So in this video, I'm not going to do justice to this company. You can't really go over the whole company in 10 to 15 minutes, but I'll do a high level overview. And if anybody's interested, I really highly recommend reading their annual report. The company does a great job of laying out all the bits and pieces of the company, and there are a lot of bits and pieces. But if you read through that, it gives you a really good sense of the company and where they're going. So this video, I'm going to go through 5 things. I'll just do a quick overview of the company and what I perceive to be their moat, which is developing. I'm going to talk about a thing called the 30/30 Club and growth in that section. Then I will talk about a catalyst or 3 that I see, and beyond that, evaluation, and then some risk items at the end. So StoneCo is a fintech company in Brazil. They started as a point of sale payments provider, but since then they have added on a raft of different offerings with the goal of becoming a full service ecosystem for merchants in Brazil. The government in Brazil changed the rules in financial services a few years ago. Previous to that, it was, I think, 5 main banks that were the only ones who were providing any of these kind of services in the country, and the merchants were very underserved forever, is my understanding. But with this rule change, it unleashed a slew of new fintechs that have taken the country by storm. PagSeguro, Stone, Nubank are just some of the new companies that are really thriving in this market. And those companies are basically eating the old banks' lunch right now, and that's contributing to the huge growth rates. So, like I mentioned, they started it as a company to take payments, but now they offer a whole pile of services: software, banking credit, CRM, inventory, omni-channel solutions, insurance, ERP, and the list goes on and on. So I've seen some videos, I've read some things that compare them to Square, but I think that they're actually much more than Square. So Square only provides a few of those things, plus some different offerings that are more consumer focused. But I heard StoneCo described as actually a combination of Square, Stripe, Shopify, Toast, and a bit of Salesforce in there too with the CRM offering. So this is a full service offering. Basically, they're trying to create a whole ecosystem of products so that the merchants can use all these different types of software and these products, and they all work seamlessly together. Now, I own a business, and it's a fundraising business in Australia, and we have a whole bunch of different software that we use, like you would for any business. We use payroll, accounting software. We take donations for clients, so that's similar to payments. CRM software. We obviously use banking and credit products as well. And then there's other software on top of that stuff. But our experience is we have to get all these different products from different companies. And so that creates two problems. So one is that you have to get a lot of them to work together, and that's kind of a pain sometimes. And sometimes they don't work together. So you end up manually extracting information from one and putting it in the other one to just transfer information or download info or whatever. And then, so that's one main problem, is the interaction between the different softwares. And the other problem is that you have to pay for all of them individually. So I'm just thinking about this through my own lens. If a company came to me and said, we will offer you all of those things, and they'll all work well together, you don't have to know any coding and you don't have to hire tech people to do it, then, and also if they said, well, actually you'll save money doing it because some of these products are we're not making a lot of a big margin on some of these, I would say there's no reason why I wouldn't do that. So basically what I'm saying here is I believe that this is a moat in the making, right? So if you can do things like offer software that works well together, and that is built based on the customer needs. So the company is very customer focused. It's very merchant focused. The president, Augusto Lins, talks about how he wants all of his employees, and he gets all of the employees to actually speak to merchants every day to understand their needs and what they're going through, so that they can solve the problems. So coming from this very customer focused angle, they're building out this software that is built with their needs in mind. So that's one moat that I see. It's really hard to, once you get into a situation like that, it's very hard to, I'm just trying to think from a business owner perspective. It's hard to want to pull one piece off and put it somewhere else. First of all, it's a pain in the ass. And secondly, it's a pain in the ass, right? You would have to offer me quite a bit of savings in order to think about doing that. And then, so that leads to the other part of the moat, where they own all the software and bits. They either develop them in-house or they buy them and bring them in under their own roof. So they're able to offer these products at below market rates. Some of them are below market rates. And what that does is it allows them to be the overall low-cost provider in this space, right? So they make most of the money on payments, and then they can add on like the Lynx software at not a very big margin. But then the overall for the customer, that's a savings compared to what if they had to go outside and buy both of those products separately. So yeah, I think this customer-focused ease of use model, it's been very successful for a company like Apple, and I do see that they're potentially building a very strong competitive advantage over the long term here. So I'm a baseball fan, and in Major League Baseball, they have a club called the 30-30 Club. So the 30-30 Club is a player who can steal 30 bases in a year and also hit 30 home runs. Now, those two skill sets are usually in totally divergent, they're divergent skill sets. So a player with extreme power doesn't usually have extreme speed. So it's very rare that you have one player who has both together. And the reason I'm bringing that up is because I'm going to develop a thing here called the 30-30 Club for investing. And for me, that's going to mean 30% growth rates mixed with 30% net profit margin. Now, not gross margins or operating margin, net profit margin. And so if we look at, like I was trying to think about this, like I cannot think of a company that is capable of doing 30% growth and 30% net margins. I looked back at some of the ones that I thought were candidates. And so if we look at Google, they're a consistent member of the 2020 club, and you can see the power that has in terms of compounding a business, right? We know what's happened with Google over the last 10 years, and they're consistently growing at over 20% and consistently have good profit margins. Now, if I look back at StoneCo, they have extreme growth rates, and the growth rates are expected to be fairly extreme for the short to medium term as well. And they've also had the ability to produce very high margins. And so they were over 30% margin in 2019. 2020 was close, they were 29%. And then last year in 2021, there was a problem on the credit side of the business, which I'll talk about in a bit. But that hurt the margins. There were some other things that hurt the margins as well. But I believe that this company is absolutely capable of getting back into this space of growing over 30% a year, that's the easy part for them. They're going to kill that. But I think they can get the margins back up to a very high level once the credit product restarts. They've grown over 10 times since 2016. And just some quick notes here. 2021, they grew 45%, and in the first quarter of 2022, they grew 87%, with 150% expected in the second quarter. So I'm kind of maybe lowballing it. I'm expecting them to grow at 80% for the year to 8.7 billion reais. Is it reais or reais? I don't actually know. But that might be lowballing them at 80% here. So, but I'd rather be conservative, and 80% is just fine with me. If we look at the total addressable market here, now this is one of the big tailwinds that they've got. The market is absolutely enormous here, and you can tell by looking at it that the credit side, the banking and credit side, is actually a huge portion of the growth potential. So they're going to need to take advantage of that moving forward. I would also add that there's some other reasons why the growth potential is huge, right? I mentioned that they are basically taking a swipe at all these incumbent banks that are just like plodding along and not really serving their clients. The clients these merchants were just dying to have somebody give them a good product to use. So these guys are just jumping on board when companies like StoneCo and PagSeguro are offering them a different option that works well for them. But on the other side of the potential is, I think I read that 50% of the country is still operating on cash. And so the central bank has created a new program called Pix, a new payment scheme, and that's a free payment app to use, and a payment processing scheme that you can use as an individual. And companies like Stone, with their point of sale systems, take the Pix payments on the system. Now, they don't make that much money on the Pix transactions. So if you're comparing it to like a credit card versus a Pix transaction, they prefer the credit card transaction. But as Augusto Lins says, this is not actually a war on the payment systems in Brazil. It's the central bank's war on cash. They want to get people off cash and digitized into the economy. So as people move away from cash and get used to using these like Pix, that can be their first platform. But a lot of the time they'll if they're going through a bank, the bank will give them a debit card and a credit card to go along with it. And I've read a lot and heard a lot of people saying Pix is dangerous for a company like Stone, but I think right now it's beneficial just to get people off cash and into the system that Stone uses. On the other side too, if you just think about it, I was thinking about this from my own perspective. If you gave me an option to use a free payment system versus using my credit card to tap, I would still use the credit card. And the reason why is because the credit card gives me rewards points. It doesn't cost me anything to use credit cards. I'm sure the merchants prefer using cash, or let's say Pix. If we had Pix here, they would prefer that. But ultimately, the consumer decides here. Like everyone uses the credit cards here, even though it's better for the merchants in North America to use cash. So I would assume there's a bit of a moat around the card business just because of the rewards issue. And in short, I'm not worried about PIX. Once the hyper growth stage is over, in terms of cash is getting crushed and all the merchants are actually set up with these systems, and the new world is sort of in place and the growth rates slow down, I might get worried about PIX at that point. But right now, there's enough low-hanging fruit for everybody to eat really well. Okay, on to catalysts. I love having an event or something that's going to happen at a certain date in the future, so I can have an idea about it, about unlocking value, and then I get to actually test my theory because the event will happen, and then I'll get to see if I was right or wrong. So I think there's a few of those with Stone, which I really like. And the first one is the credit side of the business. So they have two credit products, or they had two credit products, which one was a working capital loan, where the merchants get paid by credit card or whatever, and then there's a waiting period until they can actually receive the funds, or a customer pays on installments. And what Stone does is they'll advance the money to the merchant and take the receivables off their hands, and then they own the receivables. And they do that for a fee. The other side is they had customized credit products where they would loan certain amounts of money. The merchant could decide how much they wanted or what their payback system was. But what happened is the central bank changed the registry system, which means that, and without getting into it, basically Stone found out that the collateral they thought they had for these loans ended up being non-existent in a lot of ways. And so they started taking heavy losses on this side of the business and promptly shut it down and went back to the drawing board to rework it. So that was something that was a bit out of their hands. Also, I think they probably weren't being safe enough for this one, but the registry change kind of came out of nowhere, and there was a loophole that the merchants took advantage of. So that's why the results in 2021 were down. There was a lot of these credit losses that ate the earnings. But the catalyst here is that they're actually going to restart the credit side of the business in late 2022. And I don't think the market is pricing that in at all. I think the current market price maybe values the payment side of the business. I think it's even cheap if you just on that basis. But I think the market is basically pricing in that they're going to either get this wrong or they don't think it's going to happen, because there's essentially no value being placed on this. But the credit side of the business, as we see in the total addressable market, the credit side is enormous. And it was one of the things that helped them create these huge profit margins before. So this is coming back online. And I think that that's going to put a rocket under this stock if they get that right. Now they haven't put any details out on what exactly they're going to do, but they have hired a new head of credit to take over this part of the business. And also what they're doing is they're putting in all these new types of guarantees to protect against the situation they had last time. So they think they're going to get it right this time. They've been spending about a year planning for this, but that has a massive potential for upside if that goes right. The second catalyst I see is interest rates. So when interest rates went way up in 2021 due to inflation going crazy in Brazil, what happens is that squeezes the margins on their business, and it takes them a while to reprice their offerings to regain those margins, which they've done now. They've increased their take rate now on this side of the year. But last year they were intentionally not adjusting those prices, just so that their merchants didn't get hammered by the change. So they took a bit of a hit for the team, and I think that's probably paying off with loyalty. But there's no way to test that. So that's another Oh, sorry, I should explain the catalyst more. So the thing that happens if interest rates go in the other direction, they go down, their margins actually increase. So, I've been watching markets for a while now, and one thing that you can be sure of is interest rates will go up and down, right? And they're quite high right now in Brazil. And all it will take is some kind of economic problem for them to start loosening their monetary policy and trying to help out the economy by lowering rates. So I can't gauge when that's going to happen, but I'm pretty sure it's going to happen at some point. I highly doubt that rates are going to go up forever or stay up. So so we just have to wait for that. And the third catalyst I see is actually a bit of a contrarian view. There's an election coming later in the year, and I think the market's a little bit scared of that in Brazil because the right-wing party is in right now at Bolsonaro, and the leftist party looks like they're probably going to win the next election because Bolsonaro's made such a mess of a lot of things. But I was looking more into their main candidate, Lula, and his economic record is actually pretty good. He was the president from 2003 to 2010, and he actually did quite well with the economy. So let's see if I can read this thing. What does it say? It says, Brazilian manufacturers, banks, and retailers benefited from the consumption-led and credit-fueled government economic model. So if Lula is anything like he was before, that probably means interest rates are coming down. That probably means that those similar types of policies will be put into place. So that's a bit of a contrarian view, and the simplistic view is the lefties in bad, righties in good. But if you look at different countries around the world, that's not necessarily true. There's not a guaranteed like good bad line. So I would say this is potentially a hidden upside. Now I've just done a quick valuation here to give you a sense of the power of growth and net margins. So as you can see, my growth expectations go from 80 this year, and then they go down. I drop them down after that, but still healthy growth all the way through. Now the margins, I have them rising until 30%. That's just a ballpark number, just to see what would happen. I don't really have a gauge on when they'll exactly when they'll return to those healthy levels. Could happen next year if credit goes well. But one of the other things that we need to take into consideration is the Brazilian reais, which back of the napkin seems to depreciate at about 12% a year historically. So as you can see there in one of the yellow sections, that's the depreciation of the currency over time. And that is a big factor when you're looking at a company like this from Brazil. But if we look at the market cap expectation, and that's just based on a price earnings multiple, you can see in 2027, based on those growth rates and those margins, the company could be worth close to 30 billion US, even with the depreciation of the currency. And so that's a 10x from here. So I would say that that's pretty good upside. I would never be upset about getting 10x over 5 years. But if you're looking for more, then I don't have an answer for you. And finally, in terms of risks, I'll just go over a few of them here. We talked about PIX. I don't think PIX is a risk in the short term. Maybe in the long term when when this type of space is saturated. So we'll keep an eye on that, see how that rolls out. But I don't think that's a major risk at this point. I actually think it's a benefit to them right now. The Brazilian reais, which we talked about, that we're going to have to expect that depreciates over time. And so what that means is there is a requirement here for growth. If we start seeing growth that's close to this depreciation rate, that's actually a net zero growth from a US dollar perspective. So if the reais is depreciating at 12% a year, you basically need 12% growth in their local local sales just to stay even. So that's a bit of a problem. But on the other side, if you have high depreciation in the currency, it probably means the inflation rate is high too. And so StoneCo, I should have said this before, but StoneCo has a great inflation protection mechanism, because if there's inflation in the system, it basically affects the purchases, and they are taking a percentage of purchase. So there's a natural inflation hedge there, which I think should probably drive the growth rate much higher, right? So if you had 12% inflation, 12% currency depreciation, the revenue should just be going up by 12% based on the inflation rate. But again, it's something to watch. If the growth rate dropped down into the 20% range, I'm probably going to retake a look at this to see if I feel the currency risk is worth holding on. Another risk is, it goes without saying, in South America, you always have the risk of, populist politics and crazy decisions by the politicians. I forget who it was. I think it was Andre Street who said, somebody asked him, they said, "Oh, what do you think about the stereotypes about Latin American politics?" He says, "Oh yeah, they're all true," right? So Andre Street is the founder of the business. So that's always a risk. We've just got to keep an eye on it. The last risk, I think, is the biggest one, which is competition. You have very hungry competition and very smart competition. PagSeguro is the closest thing to Stone, and they're more focused on micro merchants, whereas Stone is more medium, small business. But they're both moving into each other's territory. But PagSeguro doesn't have the ecosystem of products to add with it. So I think that I would be more worried if I was PagSeguro than if I was Stone in that one. But the bigger risk, I think, is Mercado Libre. They've gotten into payments recently, and they're starting to get in other products as well. And these guys are the 800-pound gorilla. They have deep pockets. They're very smart. They're very aggressive, and I'm going to keep an eye on them to see if they try and take a big swipe at this part of the market, because that would be quite dangerous. They also have the advantage of having the Mercado Libre site, which presumably they could add some benefits to these merchants who want to do online selling as well. So that's the biggest one I'm keeping an eye on. So in the end, I think this company has a massive potential. This 30-30 club idea, if they can pull this off, I think there's some huge compounding available with this company. If they execute on their plan and grow like crazy in Brazil, and then eventually outside of Brazil, which adds another layer of growth potential, then all bets are off. But for me, the key here is the growth and to keep an eye on competition. If they can keep the growth rate very high and they can maintain their retention rates by increasing the stickiness of their ecosystem, like an Apple or a Salesforce does, then I think this definitely has the potential for permanent holding status. Anyway, I hope I touched on some of the useful things there in Stone. Like I said, there's a lot of other stuff, so I suggest really reading up on it if you're interested. I have not done the company justice in this video, but if you made it this far, I'd say thanks for watching and see you in the next video.